Okay, so I'm going to go through the capstone final examination on module 11 in English, and any case you want to clarify the explanation or anything in Mandarin, just feel free, and I can answer your question either in Mandarin or English. See how you're going to ask me, and see whether I can answer in Mandarin as a whole. Okay.
Okay.
Okay, so without any delay, so I'm going to start now and see if I can actually go through all the materials I have prepared for module 11. And for module 11, I want you guys to prepare 4 materials, including 3 items in capstone final examination, including the pre-seen materials, question and answer book, 3 materials as a whole, and then lastly, exam guide of module 11, because I'm going to use module 11 exam guide, some mind maps to actually support my answer for. So better for you guys if you have all these 4 materials on hand. Okay, so for present, I'm not sure if you have seen the past exam, the brief materials prepared by myself. But if you have, then you will know my style is that I'm going to start with the present materials, because because everyone knows that you're going to have the present materials before your actual examination, and how we are going to leverage the present materials is very important as well. So for the present materials, if you have already gone through the materials in a very detailed way, then I bet you guys can actually understand how to use these materials for module 11. But if not, then I'm going to go through with you guys. But in case any points that you want me to stop or you want me to clarify in either English or Mandarin, just stop me anytime. And if you want to mark down your question in chatbot, just feel free as well. I'm going to answer after my debrief as well. For present materials, please turn to page 8, because this is the first item that I find which is relevant to module 11. Page 8. Page 8. Under the challenges, you can see that under the challenges, the the case actually detail out that the company invests heavily in R&D. For any cases, if you see the company heavily invest in R&D, please turn to HKAS 38 immediately. HKAS, which is page 7 of the exam guide, because we are going to heavily leverage the exam guide of module 11. It details out all the I would say keywords that have to be listed out in the answer book. For R&D, which is under intangible assets, HKAS 38, we have to clearly understand when the company can actually capitalize the expenses or the cost into the balance sheet, and when the company cannot do it. For all the internally generated, which is the most, I would say, debatable cost, which the company can or cannot capitalize in the company's balance sheet, we have to understand whether it is related to research or related to development. If it is a purely research cost, which means we are not going to develop anything within the company, then we have to expense right away. But once the company is going to develop some assets in the company based on the research result or based on any kind of findings, then we are able to capitalize once the following 5 criteria have been met, including we have to prove the company is technically feasible to complete the development, and the management has the intention and has the ability to complete, and it is going to generate probable future economic benefits to the company, and we have enough resources to complete the development. And at the end of the day, the cost can be measured reliably. When we have been able to prove all 5 criteria has been met, then we can capitalize the cost into our balance sheet. Okay, so for this point, once we find this kind of information from our PC materials, we have to go back to HKAS 38 to refresh our memory in Module 11 because it is something related to HKAS 38. So we can mark the relevant standard here to remind ourselves to read the relevant materials for preparation of any kind of questions. However, if you're going to deep dive the materials, you will understand, yeah, the company actually invests heavily in R&D, but more likely, or I would say most of the R&D time has been investing in learning the latest trends and technologies to keep their platform updated. So it is something more on learning side. If it is something on learning side, then we are going to regard it as research because learning is about some research, but not developing anything into our platform or into our application. So for this part, then we are sure. So we are going to say for learning, it's more on research part, and as such, we cannot do any capitalization of the cost. Okay. So this is how we are going to see this sentence. Nothing has been developed based on the learning process. Even though there is something developed, we are going to capitalize the cost incurred in the development only. For all the costs incurred during the learning process, we cannot do any capitalization, including payroll, including traveling fee, including the expenses we are going to acquire some license for the learning. All the learning process we do not able to capitalize it because we do not actually develop something to generate probable economic benefits. The key rationale is from the learning process, we cannot be very confident to say, okay, some economic benefits can be generated for sure. And that's why we cannot do any capitalization here. This is the first item that is relevant to Module 11. And the second item, we are going to page 10 of the precinct materials. Page 10 of the precinct materials actually detail out that the social media crisis can arise unexpectedly, right? And for all the unexpected crises, we should from the accounting perspective, from the accountant's perspective, we should actually assess the relevant potential expenses with our in-house lawyer, if there's any, to ensure that all the contingent liability, contingent asset, and also if there's any provision is required to be made in our balance sheet, we have to do it properly. Okay, so whenever we find that there is some social media crisis, we have to look back to our contracts to see whether there is any clauses to actually expose ourselves into different potential liability. Because for some terms and conditions under different contracts, maybe the repetition risk is actually related to our company. If that's the case, we have to assess if we should make any provisions or disclose any contingent liabilities in our financial statements to ensure all the relevant potential liabilities is to be disclosed in our financial statements. This is something we have to be aware of. Okay. This is the second item. And the third item, we are going to page 13. Page 13. Under page 13, Exhibit 1, asking why do conglomerates acquire social media marketing agency? By the word acquire, we should actually be sensitive about those acquisition standards because there are a few standards related to different kind of requisition, including HKAS3 business combination, HKFRS 3. Business combinations. If we're going to control the company, and the parent standard is HKFRS 10, consolidated financial statements. Because when we acquired the control of our company, then we have to consolidate the financial result of the acquiry into our financial statements. And if we are not able to obtain control, then we have to assess whether we have the joint control right, or whether it can be qualified as our associate according to HKAS 28, or even though we are not going to have certain control, then we have to see whether we should actually list out the investment in our financial statements as a normal financial asset, which is according to HKFRS 9. Then we have to go through all these standards to at least understand the high, or refresh your memory on those high level rationale or key items, key points of these standards, because you can see from the printing materials there is something about acquisition, and that's why we have to understand the accounting impact or the financial impact under different acquisition scenarios. This is how we're going to see acquisition point. And the last item I can find from the materials, which is relevant to Module 11, is from page 16. Page 16. Page 16 is about environmental changes in the industry. This exhibit actually details out different kind of environmental changes in the industry, and I think both of you guys actually understand ESG is definitely one of the hot topic under Module 11 to be examined in capstone examination. And that's why once we can see that, okay, there's environmental changes in the industry, we have to immediately relate it to environmental, social, and governance framework, and see whether we can, as the director or as the company key management, how we can actually inform our stakeholders, including customer, vendor, or even though different kind of regulatory bodies, about our environmental, social, and governance directions, and also different kind of actions have been taken into our ESG reporting. And it is very important for us to relay all the effort to the society to ensure that or to demonstrate that our company actually take high, very, I would say, very considerate about the ESG impact to the society. And this is the last item I can find from the printed materials, which is very important to Module 11. And I'm going to pause here for a bit first, and then see if you guys have any questions related to the printed materials, or if you find any special sentences, special paragraphs, or special pages which you may find relevant to Module 11 and you want to ask first.
No.
Nana and Ning, do you have any questions here?
No questions.
No question.
Okay, great. Then I'm going to demonstrate how we're going to use the printed materials. So for the upcoming mock examination, and even for the real examination, I hope you guys can actually do this kind of linkage between the printed materials to the standards under Module 11. And this helps a lot because it helps you to refresh the key points of different important standards, and this is very important to do so. Okay. If no questions, then I'm going to go through the capstone examination question. Okay, so I'm going to go through question 3 with you in the upcoming hour. For question 3, you can see there are 3 requirements. The first requirement is asking us to explain the rationale of how the currency forward contract helps the company to reduce the exchange risk. This is the first ask. We have to explain the rationale of why we are going to use currency forward contract, how it can help us to reduce the risk, and explain the impact on the financial statements in relation to the hedge arrangement. Okay, we are going to answer in a very high level way. We don't need to include any kind of debit credit accounting treatment and also the journal entries. And I understand most of you guys because I was a student before, and that's why I understand whenever we see, wow, forward contract, option, futures, once you see this kind of words, you feel very scared, especially for those pure accounting background students without any touch on the investment side or different kind of corporate financing. But again, when you see this kind of questions, you don't need to be afraid because we just need to justify why we are going to use this one. You can use common sense to answer this question because I totally understand this questions is very panic to most of the students, but you just need to use common sense to answer why there is exchange risk first and why we are going to use this forward contract to reduce the exchange rate risk. At the end of the day, we don't really need to understand why forward contract is important in this question. We just need to explain there is exchange risk, and we are going to use this method to reduce the risk. We just need to use this kind of thinking process to answer the question, and then for sure we can get the passing score already. Of course, if you do not really understand the forward contract, of course you cannot get full mark, but it already ensures that you get the passing score once you explain why there is exchange rate risk and how we are going to use this kind of method to reduce the risk. And of course, the second part of the question is explain the impact on the financial statements. We just need to say, okay, by using this kind of method, the impact on the financial statements, of course, is to be reduced. Once you answer in this direction, I can ensure that you can get the passing score. And later I'm going to go through with you guys how to get high mark, but just realize when you see this kind of question in the real examination, you don't need to be panicked. I would say just calm down and then answer those basic information. Then you can get the passing score on this question already. Okay, this is requirement A. Requirement B, the company is negotiating a new contract with the customer. Actionware, the Actionware is the customer of the company. It is negotiating a new contract with the customer, and asks you to suggest two other arrangements, except for the contract that mentioned in question A, currency forward contract, that could help the company to reduce the exchange risk in similar situations. And 4 marks for each arrangement. Okay, so for this point, then I'm going to list out all the potential possibilities, and I think as one you can think of for now for sure is that of course we are actually in the moment of negotiating a new contract with the customer. Why don't we include the relevant risk in the contract as well? Because for the relevant exchange rate risk, there is potential gain as well. Because the currency is actually fluctuating all the time, you don't really exposed to the loss. Maybe you exposed to the gain as well. And that's why while you're negotiating the new contract with the customer, of course, you can ask the customer to actually absorb the relevant risk as well. This is the first potential arrangement that you can think of for now. But of course, we are going to go through the remaining possibilities as well, and which is relevant to HKFRS 9 as well. Okay, and this is requirement B. And the last requirement is asking you to explain to the management if you agree with France's actions and justification. Then we have to go through what Francis actually do to the company, and then we have to find out from the business and ethical perspective whether we agree with his actions and justifications. And if we do not agree, then of course we have to recommend some follow-up actions. And this is for this whole questions, three sub-questions as a whole. Then go to the details. I'm not sure if you're aware, for module 11, in capstone examination, most of the Q&A actually do not really need to rely on the present materials. Starting from the start of the capstone examination. So, for most of the module 11 Q&A, not most, but all the questions for module 11, it really leads us to look into the question before the I would say the materials before the questions only. I would say this is an interesting finding. Okay, look into the case information. A few months ago, the company engaged as a marketing consultant by the new customer to for expansion in mainland China. It is a very huge company, and of course the marketing campaign launched in a success way, and that's why they're looking for they are actually looking for a 3-year marketing contract with the vendor. And on several occasions, different occasions, actually, Digit More, the company, the vendor, we are actually being requested to do advance payment. That means the company has to pay in advance first on behalf of the client, and then do reimbursement approach. And this is most of the audit, I would say audit firm approach, and this is not something very new to you guys, I believe. And you pay first and then do reimbursement later. However, the functional currency or the presentation currency or even the local currency are not the same. Digit More is actually in Hong Kong, right? And that's why their key currency is Hong Kong dollar, but Actionware is a foreign company and their home currency is M dollar, and that's why for different currency, when the reimbursement is not on the same day with the payment day, one company has to be exposed to the exchange risk. Okay, if their settlement date are not at the same day, they are exposed to the exchange risk, because either M dollar go depreciated or appreciated, the exchange rate risk is there. Okay, the hidden cost, like what I said, is that about the time lag between the expense enhancement and the reimbursement received from the customer. And it is very common in the industry. I would say it is very common in the whole world. But the fluctuation of the exchange rate is something out of control, because whether M dollar is going to be depreciated or appreciated is something out of the vendor's control for sure. And the company owner, Alex, had expressed his concern about the exchange rate risk. And because the owner had this concern, CFO coming out and then say, okay, if you have this kind of concern, then I'm going to arrange a forward contract to mitigate this risk. And under this forward contract, we are not going to suffer any exchange loss for sure. And for this forward contract, if you are not familiar with futures, forward, and option, then I can say it here in a very high level way. For forward contract, it means there's a predetermined rate. Predetermined rate means we are going to confirm the rate we are going to settle our contract at a future date, at the contract inception date. Okay, so at the contract inception date, we have already confirmed the rate that we are going to settle in the future. So if the owner has the concern on the exchange rate risk, then we can actually deal with our counterparty. Either it can be banks, either it can be another vendor, or either it can be normal third party individual. They can deal with it and then say, okay, we are going to settle in a future date at a predetermined rate. Once the contract is confirmed, then we can safely put the exchange rate risk to another one's basket. Okay, we are not going to expose any kind of exchange gain or exchange loss from this forward contract. Okay, so gain, nothing related to your side, loss as well. This is how forward contract actually works. And okay, from the options is different. It's a bit different. It's at predetermined rate as well. However, it is optional for the company whether to exercise it. For forward contract, mandatory. In the future day, you have to exercise the contract based on the predetermined rate. You cannot revert the contract. You cannot cancel the contract. You cannot say, I'm not going to exercise the contract. It is a mandatory action for the holder and the seller to exercise the contract. However, for option, it is something different. It is optional. Once we buy it, we are optional whether we are going to exercise it. So when there is any optional, I would say you can feel free to exercise or not. The cost is higher for sure. There is cost. We have to pay a cost to acquire this option, unlike forward. Because forward, we are going to deal with the counterparty. Maybe there is a cost, but the cost is less for sure. Because we are mandatory to exercise the action, the cost is lesser, more on the administration cost. However, for options, the cost is more on the options to buy this cost. And last but not least, once we talk about derivatives, there are forward, options, and lastly, futures. Futures, predetermined rate as well. In the future as well, for sure. Oh, sorry, predetermined rate. In the future, also is mandatory. However, the key difference between forward and contract is futures is usually traded in stock market only. For forward, it's like anywhere, like what I mentioned just now is that you can deal with you can deal with a bank, you can deal with a vendor, you can deal with normal third-party individuals. So for forward, it is more flexible. However, it's only flexible for how it is going to be negotiated, but you have to do mandatory exercise at the end of the day. Okay, so this is a high level comparison between forward options and futures if you do not have such sense before this lesson. However, this is not that important for us to get passing score for this question for sure. Is that okay? CFO say that, okay, I'm going to enter some forward contracts for you to mitigate the risk. So owner Alex, you do not need to be worried so much about it. Okay. And last week, the customer Actionware settled all the disbursement in $, and Digimore fulfilled the forward contract as agreed. Okay, normal. It's like we are going to exercise, we are going to fulfill the contract we actually agreed. And However, Alex find that the current exchange rate between M dollar and Hong Kong dollar is higher than the predetermined rate as fixed at the forward contract, and find that in the financial statements, no exchange gain was recorded in the financial statements. He did not understand why, and he expect the contract only help to reduce the potential loss, but not the gain. Okay, and that's why we have to base on these three paragraphs to answer question A. For question A, how we are going to get the passing score? First part, I'm going to tell you guys how to get the passing score. Passing score. First one is about the note format. The note format is easy. You just need to take one reference as example and then just copy the format is to, from, and regarding which subject. And then we're going to detail our question section by section. How to get the passing score is that we are going to use the hedge arrangement for sure. And this time we're going to use forward contract. We have to answer at the first point is that, okay, under the current arrangement with our customer, because we are going to pay first in Hong Kong dollar, and later on, the customer is going to pay back us in foreign currency M dollar. This one, if the action date is not on the same day, then we expose the exchange risk because the market currency rate is fluctuating, and that's why we are exposed to ourselves to exchange rate risk. We may suffer a loss, or we can actually have exchange gain if we are not going to use any kind of hedge arrangement. And this already gives you some background, and we can say that to mitigate this risk, under this case, CFO actually proposed the company to enter the contract about currency forward contract. And based on this, we are able to mitigate the risk. And this is the second paragraph about this item. And normally, if you guys don't know what forward contract is, you can be able to answer the first two paragraphs because this is something, just a further elaboration of the case information. Then, but the point is, it is already enough for us to get the passing score. It's about, okay, current arrangement, we exposed to the exchange rate risk. Can be a loss, can be a gain. And right now, CFO say that we are going to do the forward contract. And under the forward contract, we are able to actually sift out the relevant risk to the external party based on the predetermined rate. And this is the first two paragraphs, which is a further elaboration of the case information, okay? And if you know more, then you can, of course, get the high score, but this is something that you can just write if you are able to explain it in detail. Otherwise, I would suggest you guys to skip the relevant explanation if you don't really know about the details, because it's better for you to save the time to do different kind of to answer different answer if there is more questions that you feel comfortable to answer on. But if you know what is the forward contract is, then you have to say under forward contract, which means the exchange rate between M dollar and Hong Kong dollar was effectively fixed during the contract inception date, which means that during the time that you pay on behalf of the vendor in Hong Kong dollar, then you can find the immediate spot rate of the M dollar and Hong Kong dollar, and you can fix this exchange rate with the external party, and then say that, okay, once the customer Ashmere is going to pay you back in M dollar, then under this contract, it is obligated for you to convert it to Hong Kong dollar at certain rate. which is of course stated in the contract, back to us. And based on this arrangement, the relevant exchange risk was mitigated. Okay, this is how the forward contract works. And under this case, of course, we are going to say that under this contract, all the translation gain and loss would be offset to each other, because the company is using hedge accounting. So all the translation gain and loss will be offset to each other. And that's why in the financial statements, we will not see material exchange gain or loss in the financial statements, because all the potential exchange gain loss would be shifted to the counterparty, except to be absorbed under in our financial statements. Okay, so you can see that we have to answer back to the owner question is, Alex, okay, you look it correct. The financial statements, we are not going to have any exchange gain, because all the gain and loss will be shifted to the counterparty of the forward contract, and that's why no gain or loss was reported in our financial statements. This is how we are going to get full mark in our answer. But again, it is very common for us to face different question in the question book. Once we find this question is for module 11, I would suggest you guys to actually expand the explanation of the relevant materials first, and it secures you to get passing score. Don't just skip the questions, because if you look into the panelist report, some of the candidates actually skip these questions based on once they see hedge arrangement, hedge accounting, but I will assure you guys that no need to be panicked. Just expand your explanation here, and then at the end of the day, you can get the passing score here. Okay. And this is for question A. I'm going to pause here first for a few seconds and then see if you have any questions about question A.
No.
No question.
Okay, good. If no questions, then I'm going to move on to question B. Okay, question B is about asking us to suggest two other arrangements besides for a contract to reduce the exchange risk. Okay, so right now we are going to negotiate another deal with our customer, because our campaign is very successful, and then we have to find two other arrangements, like what I mentioned just now, because we are at the moment to negotiate a new contract with our customer. Of course, we have to try our best to reduce all the side arrangements, because for us to actually engage different parties on forward contract, future contract, or options, actually it incurs many time, effort, and resources to ensure the contract is actually match our expectations, etc. And that's why, from the management point of view, it is better to actually shift out the risk, the relevant exchange rate risk, to our customer directly. It would be the best. Then for us to answer this point, then we have to say that, wow, of course, it is better for us to negotiate terms with customer in the new arrangement. We should try to include all the exchange risk in our settlement in the future, because it really depends on whether the customer is willing to accept it. Because again, there is potential gain and potential loss. It is not something that asks them to absorb the loss. We are just asking them to absorb the relevant risk, and that's why it is something negotiable. And we should try our best to negotiate this risk to them instead of absorbing on our own, if our owner do not want to actually absorb the relevant risk. And at the end of the day, when they are going to settle the invoice in the future, then we can include the relevant exchange fluctuations in the invoice and bill them directly, or ask them, or we can try to ask them to settle their invoice in Hong Kong dollar directly. And at that case, then all the exchange risk of Ashmere, our company, would be mitigated. This is, of course, the perfect scenario because it saves us lots of time and effort and resources to negotiate separate contracts with another party. And this is something, as a CFO or accountant, we should bear in mind. It is always be the best if we can put different contracts into one. And this is how we should manage things in the company. And of course, we have to actually recommend this proposal to our management to see whether they are okay to negotiate with the clients in this direction. But the question is asking us for two recommendations, and that's why we should actually throw at least one more. Okay, one more is we just talk about forward contracts and futures. So except for forwards, we can actually propose either options or futures in our case. And for options and futures, these two actually require higher cost than forwards because it like I explained before is that options is because it is something optional for us to exercise or not, and that's why the cost must be higher. And for futures, because it is only tradable in stock market, and that's why we may not be able to find the most preferred predetermined rate in the market because it is traded in stock market. Stock market is not that, many options like okay, action rate is going to settle 500 M dollar 30 days later. We may not be able to find the perfect match in the market. And that's why forward would be the best option out of these three if it is a tool for us to mitigate the exchange risk. However, if we can if we are going to if we are being asked to propose which one out of these two is a better one, then we have to see the case. The case is actually a very tailor-made one because we are going to mitigate the risk for the M dollar receivable from the customer. And that's why I would say option would be a better one comparing to futures because because we can actually protect ourselves from the exchange rate risk for the exact amount of money. For futures, because it is really on stock market trade, and that's why we may not find that perfect match. And that's why, as a company management, it would be better if we are going to do currency option, because the point is um we are going to do the exchange rate mitigation in a perfect way. However, we should remind the management there is a fixed cost comparing to futures and also forward because it is something optional, and we have to pay a premium to buy the relevant right for us to do this currency option. This is the second and the third option you can think about. And the last but not least, if you look into the answer book, there is a short-term loan. I would say this is not preferred for sure because we are going to borrow a loan to mitigate the relevant exchange rate risk, which is not, I would say, definitely not preferred by any financial management, uh, because we are going to pay interest, and also if we are going to get the money in advance and at the end of the day we spend it in a different way, and we do not have enough money to repay the loan, then we exposed to cash flow issue. And that's why, to mitigate the risk, we do not suggest to obtain a short-term loan. So in your answer, I will not suggest you guys to write we're going to obtain a short-term loan unless uh, they're asking you for four or five ways to this recommendation. Okay. Otherwise, this is something not feasible, I would say, from financial point of view. We are going to expose ourselves to interest rate risk and also to liquidity risk, and also most like unlikely, but possibly is about going concern issue. This is not something. This is not something justified to mitigate exchange risk purely from this point. Okay, and this is for part B. And C, do you have any questions? 然后 okay, so let's move back to our question and answer first, and then I'm going to respond to Lana and Ling's question later on. And for question C, we have to actually see what Francis actually did to the company, and then analyze from business and ethical perspective whether his action is justifiable. And then, of course, if not, then we have to recommend the follow-up action. And okay, so Francis is a qualified CPA, which means he actually understand what a qualified CPA should do is about objectivity, integrity. He should actually doing action under different professional qualifications. And he is also very concerned about ecological friendly and do not want to waste any kind of resources. And once he understands that actually there is a figure being left from the event, he immediately sold the figure to his friend who owns a small toy in Hong Kong for decoration only, not for sale, but for decoration only. And he immediately returned the sales process to the company and saying that, okay, it is the best value from the selling of the figures, and hope that it is a very good deal to the company. And he did not personally benefit from this action. And for this kind of action, of course, it is not acceptable. It is not acceptable because even though it is really a rubbish, we cannot actually sell the rubbish to third party outsider without the consent of the owner of the item. Okay, so for this kind of answer, we have to clearly identify who is the owner of the items first. The customer is obviously the owner of the items. We have to get their we have to get their consent before we do any follow-up action on the items they left in an event. Okay, so unless we are just dispose it for any third party, for any usage other than just dispose it, we have to get their consent. This is the first key point we have to highlight. And the second key point is that if we find that it is not ethically okay, or it is not business perspectively okay, then we have to list out the recommendations. We have to list out the recommendations of the action. Is that, first of all, we have to immediately find that we have to immediately talk to Francis that whether the item can be get back. In other words, whether the sale transaction can be cancelled, and then we are able to actually refund the whole amount to the third party that Francis has been sold to. This is the first item we have to talk about. The second item is that we have to talk to the supervisor of Francis, of course, because it is not something okay. The behavior is not something okay, and that's why we have to ask the immediate supervisor of Francis to talk about the action items they are going to do on Francis. And then in a long-term perspective, we have to ensure that all the policy and standard procedures should be set up properly to ensure there is no second time on this kind of actions. And also, the management should actually think about any potential scenarios they can think about, and then set up the relevant procedures as well. This is how the company can do regarding this transaction. This is on question C. Okay. Thank you.